This is Andy Warwick with Loan Depot in Dallas, Texas. I want to talk today about how to shop for a mortgage loan. I've been doing loans for over 30 years, and I can tell you that 97% of all the people that call in to look for a mortgage, the very first thing they ask for is, what is your interest rate? As if that is the only thing that's important on a mortgage loan. So I want to give you a couple of ideas, options, and tips when you're shopping to buy a house and you're shopping for a mortgage loan, whether it's a purchase or refinance. Mortgage loan officers are debt management experts, and let me tell you why that's important. We see the entire debt structure from our customers. We see their income, their assets, and we see hundreds, if not thousands, of these transactions and these profiles over a period of time. And you get to be really, really good at determining when somebody's debt is a little bit outside the boundaries or outside the norm. And we also have a lot of options in how we structure mortgages because everybody's different, and some people can't get, they're hard pressed to get any down payment together. Some people get 20 or 30, 40% down, and we get everything in between. So we've seen it all. And what ends up happening is so many people start the conversation with, what is your interest rate? And depending on how the conversation goes, they lock into the mortgage lender that gives them a number that's lower than everybody else, and that's where they stop, and they don't go any deeper. So a couple of things to consider besides just the interest rate, which is very important. For example, let's say that you're considering buying a home at $300,000 and you're going to put 10% down. It's $30,000, and that's great, and you're going to have lower mortgage insurance and putting 5% down. But for some people, putting 5% down makes a lot more sense. Because when you put 5% down, your loan amount is going to be a little bit higher, and your mortgage insurance is going to be higher, so your monthly mortgage payment is going to be higher, which doesn't sound good. But you've also got $15,000 of additional funds to pay down your alternative, your other credit card debt or installment debt. And so your debt structure after closing, your total monthly debt is significantly lower if you put 5% down versus 10, and you use the extra 5% to pay off other debt. That's the type of stuff that we deal with on a daily basis. Whether people are putting 3 or 5, we actually have clients that a lot of times they'll come in and they're going to put 3 or 5% down, and depending on their debt structure and their credit score, another option is down payment assistance. We might actually refer them to a down payment assistance program that carries a higher interest rate because it saves the entire 3 or 5% out of pocket for them to use to pay down again credit card or student loans or installment loans. So oftentimes it's the alternative foregone, and because you don't get in that conversation if the only thing you're comparing is an interest rate. Something else to consider is mortgage insurance. When you go in and everybody typically gets a standard monthly mortgage insurance payment, which is great. It's a really good way to finance the mortgage insurance. That's how 99% of people are going to finance their mortgage insurance. They're going to pay it on a monthly basis. But an alternative is to pay the mortgage insurance on a one-time premium up front, and you pay it one time at closing, and you don't have mortgage insurance. And the reason most people don't do that is because it's going to cost them an extra 1.5 to 2.5 points or percent. So in just a minute, we're going to talk about negotiating a contract sales price. But if you've got an extra 1.5 or 2%, that's an option to consider. And you can also do what's called split mortgage insurance. Split mortgage insurance is when you pay a portion of it up front at closing, and you're going to pay the rest of it on a monthly basis going forward. And again, by paying a portion of it up front, you can significantly lower your mortgage payment. Another thing that we see a lot of are renovation loans, or the need for them. And let me tell you what happens a lot. And I get these calls once a quarter. I've done a loan for somebody 4 or 6 or 8 years ago, and they love their house, but they decide they want to do a renovation. So maybe the house was worth $300,000 and they put $30,000 into it, and now the house is worth $400,000, which is great. The problem is they have $30,000 of credit card debt, and they call me up and want to refinance and get their cash back out to pay off their credit cards. But what's happened is they started with a 780 credit score, and now their credit score is 630 because they've maxed out all their credit cards, and that causes your credit score to significantly drop. An alternative to what they've done is to do a renovation loan up front on a refinance. So the renovation loans come with a little bit higher interest rate, but you don't max out your credit cards. You maintain your high credit score, and in an overall cash flow basis, you end up with a much lower mortgage payment overall, as opposed to maxing out your credit cards. Same thing holds true when you're looking at buying a home. Maybe you find a home for $250,000. It's in the right neighborhood, but it needs some work. And the thought process for a lot of people is, I'm going to put 10% down, and then after closing, I'll use my credit cards to go in and do the foundation repair, or the electricity repair, the paint and carpet, whatever the house might need. Again, what's going to happen is they're going to run up their credit card debt. They're going to be paying 12, 14, 17% interest rate on the credit card debt. The alternative would have been to get a renovation loan up front. Again, it's going to carry 1/4 to 0.5% higher interest rate. But when you put the two side by side, you're going to be a much better cash flow situation if you've done the renovation loan. So that brings us to the contracts. In a tight market like Dallas, Texas, if you're looking at a home that's $300,000, a lot of people think you're going to have to make an offer at $290,000 or $295,000, or even, let's say, $300,000 to get the house. Well, maybe instead of offering $295,000, you offer $300,000, and you ask the seller to pay $5,000 in closing costs. And you take that $5,000 and you use it for a permanent interest rate buy down. In today's market, we're experiencing something called margin compression, which means for the consumer, it's just a lot cheaper to lower your interest rate, to pay points and lower the rate, than it normally is. So in a $300,000 house, if you get $5,000, that's about 1.5 points. You use it to buy down the interest rate on a permanent basis, you're going to significantly lower your mortgage payment, much lower than if you'd bought the house at $295,000. And those are just some of the things that we get into. We start talking to people about the strategies and the best mortgage option for them. Another is when you're looking at making an offer, so many lenders advertise we can close your loan in 15 days or less, which is great. And sometimes that's going to help you win the offer. But another thing to consider is a lot of sellers don't want to close in 15 days. It's a huge inconvenience. They have to pack up their house, they have to find a place to go, they have to be out of the house in 15 days, which means they really got to be totally packed up in 12 or 13. So an option is to close in 15 days, but then give the seller a 15 to 30 day lease back. Maybe give them a 30-day lease back. 30 days after closing to move out into their new place, whatever they're going to be doing. It's not what you want to do because you're excited about the house. You want to go to closing, you want to get the keys, you want to invite the friends and relatives over for the housewarming party, which is exciting, it's great. But it doesn't always win you the offer. And sometimes you don't want to turn the home purchase process into this just nightmare of timelines and deadlines, etc. So sometimes giving the seller an extra 15 or 30 days to lease the house back goes a long way towards you helping you win the offer. And if you throw in $5,000 in closing costs for you and a lease option for them, maybe you get that offer accepted and you get a significantly lower interest rate because you're using the money for a permanent interest rate buy down. So look, we just covered quite a few different options, and none of them started with what's your interest rate. There's so much that goes into buying a home today, and there's so many different options out there. So my advice is to consider a loan officer as a debt advisor, a debt management counselor, whatever, advisor, because we manage debt. That's what we see on every single transaction, and we have to manage the numbers, and so we become experts at it. And we can really go a long way toward helping you get the right mortgage product for you, to have the best financial structure after you close, to help maximize your cash flow and to lower your payment, and get the best house for you, and finance whatever you need to finance, whether it's repairs or furniture or whatever in the process. So I hope this was helpful. There's a lot more information than just this. So if you think we can help in any way, please give us a call. It's Andy Warwick at Loan Depot, or you can direct message me, and would love to help make the process as beneficial as it can be, to keep your costs as low as possible, to give you a lot of good options to consider. And whether it's us or some of the lender that you're talking to, consider asking that loan officer for their advice given your specific individual circumstances. I can tell you that you'll learn a lot in the process, and you'll probably end up going with some variation of what you thought going into the process. Okay? Hope that was helpful, and good luck on your home hunting process or refinance, and if we can help in any way, please give us a call. Thanks.